For this mock exercise, we're going to take a look at a company called Kickback Tennis Shop. And in this exercise, we're going to actually go through the process of recording, posting, so do some journal entries regarding a transaction related to a merchandise operation. And we're going to actually prepare also a partial statement of earnings or income statement. So let's take a look at the question. So this question is about a tennis company, and the season on April 1st, 2009, these are the general ledger showed cash of $2,500. So they gave us a list of what's in the general ledger or trial balance as of April 1st, 2009. Now it's important to know that they use a perpetual inventory system, and you saw in other videos, other exercises, the difference between perpetual inventory system and periodic inventory system. And the difference in the understanding of which system to use, they use, the company uses, will dictate the general journal entries because they are different. The journal entries are different. Now, these are the transactions in April, and you'll see that we're going to go through and actually prepare the journal entries for each one of these. And we're asked to not only record, but also post it to the T accounts for each one of these journal entries, and then we're going to prepare a trial balance and, of course, a statement of earnings. So let's look at the first journal entry. So the first one says on April 2nd, they purchased rackets and balls from Roberts Inc. for $1,460. And the terms is 210 net 30. That means that if they pay within 10 days, they will receive a 2% cash discount, early payment discount. Otherwise, it's paid at the end of 30 days. And it says FOB shipping point, which means that the buyer is responsible for paying for the shipping charges. It also means that the seller is able to recognize revenue. So now we're looking at not from the buyer's perspective, not from Kickback perspective, but from the seller's perspective, which is Roberts Inc. They can recognize revenue at the time when the goods leave their warehouse, because it is now our responsibility. It's Kickback's responsibility. So, given the fact that they're using perpetual inventory system, we're going to debit inventory for the amount $1,460, and we're going to credit accounts payable. I'm going to short form to AP $1,460. Now on April 3rd, the appropriate party paid $4 for the shipping, and because we know that that is our charge, because it's FOB shipping point, we need to record debit inventory. Remember, it's freight in, meaning it's part of the cost of getting the inventory to Kickback Tennis Shop, which means we need to include that as cost of inventory. Now, on April 7th, we received a credit for $35 from Robert for a damaged racket that was returned. So we obviously opened up the boxes, and we noticed that there were a whole bunch of rackets that were damaged. So what do? We're going to record the returns. Now, because this is a perpetual inventory system, everything goes through inventory. And we saw on previous videos that if we were using the periodic inventory system, we would track the shipping charges as a separate account called freight in, and that would be part of purchases in calculating net purchase. And this one on April 7th, had we used the periodic inventory system, it would be what we call purchases, returns, and allowance, a separate account, which is a contra account, to the purchase. Again, net having incorporating that to get to our net purchased. Now, on April 10th, it says we paid Robert in full. So remember, April 10th is only 8 days from the time we bought, so which means that we qualify for the 2% discount, the early payment discount. So let's calculate, first of all, the discount. So the cash discount is going to be the $14.60 less this $35, because remember we returned it, didn't we? Times 2% to give us $29. That's the cash discount. So we know that we're going to debit accounts payable because we no longer owe it. And of course, the accounts payable is $14.60 less $35 for the return, less the $29. Oh no, actually the $29 was not recorded, right? So it'd just be $14.60 less $35. The cash amount is going to be $14.60 minus $35 minus $29. And of course, we're going to credit. Now, the cash discount, again, because this is part of inventory, we're going to credit inventory. Because it actually allows us to reflect the lowest possible cost of that inventory, which includes that cash discount, and it will also allows us to reflect the cost of goods sold when we eventually sell it properly. Okay, so in this case, because we're paying it within the discount period, we're going to have to first calculate what the total cash discount for early payment discount. And calculating that, we have to be mindful of the fact that we returned some goods that were damaged on April 7th, so we need to subtract that, multiply by 2%, and that will determine how much we actually pay the supplier. But remember, the accounts payable was recorded before the discount. On April 13th, they bought tennis shoes from Nike Sports for $460. So let's write that down as a transaction. So purchased. So debit inventory. Credit accounts payable. Now everything goes through inventory. So, but keep in mind that most companies, they will have a subledger that will track the different types of inventory that this tennis shop has. But because we're going to use a control account called inventory, everything seems to go to inventory. But of course, there's another, I call it subledger, which tracks exactly how many units of tennis rackets and tennis shoes we have. But that's really not part of the question. April 14th, we purchased supplies for $650 cash from Discount Supplies Limited. Now, when you purchase supplies, it's really not part of inventory, isn't it? It's probably things like cleaning supplies or different types of day-to-day supplies that, that tennis shop needs. So perhaps paper, pens, toner, cartridges, all that stuff that's going to be consumed in the period. So we're going to call that office supplies or just supplies. Okay, it's not part of inventory. In this case, we paid cash, so we're going to record as cash. On the 17th, we received $55 cash from refund from Nike Sports for damaged inventory that was returned. Okay, so again, we have another return scenario. So we're going to debit cash, credit merchandise inventory, or inventory, just inventory. Okay? Actually, on the 13th, I made a mistake. it says purchase tennis shoes $460 for cash. So it's really just cash, isn't it? It's not accounts payable. Okay, so you got to be careful when you read these questions because sometimes it says bought on account, which means that it's set up as an accounts payable, or if it's bought for cash, then you have to credit cash. What happened on April 20th? April 20th, we returned $60 as supplies purchased on April 14th and received cash refunds. So again, we bought a whole bunch of supplies, we opened the box, we realized there's a whole bunch of supplies that we actually didn't need, so we're going to debit cash, credit supplies. April 21st, we sold merchandise to members for $1,800, net 10 terms is net 30. The cost is $1,170. Now the reason why the cost of goods that we sold is given because we're using the perpetual inventory system, right? So April 21st, we're going to debit accounts receivable because we're giving them some sort of credit terms. It's $1,800. Credit sales. Presumably we met the revenue recognition principle because we sold it to members. It would have been in the members' hands. We've transferred the risks and rewards of ownership already of those said products to the members. So that's why we're able to recognize revenue. And because it's a perpetual inventory system, we would have to record the corresponding cost of goods sold. And the cost of goods sold was given to us with $1,170. So under the perpetual inventory system, as you saw in previous videos, we always have to update. We always have, every time there's a sale or a movement of inventory, we always have to credit or the inventory or debit the inventory. If this inventory is bought, we always have to debit inventory and all the associated charges like shipping, discounts, all goes to inventory. And then there's a sale of inventory, like on April 21st, we also have to reflect the cost of goods sold as well. But under the periodic inventory system, you'll see that I did another video on that where the cost of goods sold is not recorded until the end of the accounting period when the inventory is counted. So the cost of goods sold is actually calculated based on all sales for that accounting period. And you'll see on those other videos how we do that. On the 27th, we purchased an equipment. And because an equipment will have a useful life greater than 1 year, we need to set up as an asset. So we're going to debit equipment, and this asset, because we're going to use up the consumption of that benefit, we would have to depreciate that asset and show the depreciation as a consumption of benefit. Now, on April 28th, it says we grant a $50 allowance to a member for slightly torn tennis clothes. No merchandise was returned. So sometimes, you know, when you ever go to a store and you buy a product and then you get some sort of special discount because it's just not 100%, you know, there's something a bit wrong with it, and therefore, if you're willing to accept that discount, what happens then is they'll give you some sort of discount. So from the seller's point of view, we would debit not sales, it's another account called sales returns and allowance. And this is a contra account to sales, if you recall. And we're going to credit accounts receivable because we gave them a special credit, right? And then on April 30th, we received cash payment on account. Because we received cash payment on account from a member means that we debit cash and we credit not sales, but receivable. Because we've already recorded the sale. And now the customer is just paying us back. Okay, so these are the series of journal entries Okay, and you can see from these series of journal entries, now we're required to post these journal entries to the T account. And we talked about the T account, right? The word T means that the account is shaped like a letter T. And it's meant to accumulate all transactions related to this company called Kickback Tennis Shop. And what it's meant to do is accumulate all related transactions affecting that one account. So if you really look at this, it just helps us accumulate and summarize all activities, transactions related to that one account, and what we need to do is add the debits and credits to give us what the remaining balance is. And this is like a general ledger. So if you ever see, if you ever go to a company, what happens then is all of these gets accumulated, and the balances, the ending balances of these T accounts is how we're gonna use that to create the trial balance. Now, looking at this, we were given in the question the beginning balances. That's why they're here. The beginning balance for cash was $2,500. So let's actually go through each transaction. So April 2nd, we had debit inventory. So we need to find the T account called inventory, and we need to put $1,460 here. And we need to credit accounts payable, $1,460 here. Okay. So the posting is just a mechanical process. So this is what they call the posting to the T account or posting to the general ledger account. The hard part is trying to figure out the transactions. What are the debits and credits accounts are affected in that particular business transaction. But once we have that, this process is very mechanical. It's a matter of just posting it to the T account. April 3rd, we paid the shipping charge. So it's debit inventory, $40, and credit cash, $40. Now you'll notice that if this was periodic inventory system, you would have different T accounts for purchases, purchase returns allowance, transportation in. All of those are separately tracked. Looking at April 7th, remember what happened on April 7th? We received a credit for $35 for some sort of damaged goods. So what's the entry on that one? We're going to debit accounts payable, $35. I've already got that there. And we need to credit inventory for $35 on April 7th. Okay. Next, on April 10th, we finally paid the supplier. So what's the entry? We need to debit accounts payable, $1,425. So that's essentially, at that point, it's going to be a zero balance. If you think about that T account, we're going to credit inventory of $29 on April 10th. And we're going to credit cash, $1,396. Now, notice how in every T account, there's a date and there's an amount, and that's just a reference. And it's important to have the date and the reference, because if you can't seem to balance or you're having problems balancing your T accounts, then you'll know perhaps it allows you to quickly reference where the error where the error could be. Now, what's next is April 13th. What happens is we purchase shoes for $460, so let's debit $460. And this time we paid cash, didn't we? So $460. Okay, April 14th, we bought supplies for $650. So let's find the supplies account. $650 is here, and we credit cash for $650. April 17th, what did we do? We received $55 refund for the inventory, damaged inventory. So $55 is a credit here, and a debit of $55 here. April 20th, what happened there? Received $60 cash, purchased for supplies, purchased, and we got a refund. In other words, we actually returned a whole bunch of supplies. So we debit $60 cash here. and we credit supplies. '21st, we sold merchandise on account. So we need to debit accounts receivable and on the 21st. So that's why there's a debit there of 18. And we're going to credit sales. $1,800, right? Then we need to reflect the cost of goods sold. So we need to debit cost of goods sold. How much was that? $1,170. And we need to credit merchandise inventory. You can see by constantly updating the inventory, this number should be your ending inventory balance. We'll see that in a minute. Then on April 27th, we bought an equipment for $1,800. So we need to find the equipment. And we have it as accounts payable. Okay. So I just did that, 1,800, okay. The 28th, we had a sales return, so we need to credit accounts receivable for how much? $50. And we need to keep the sales return separately from revenue, because, right, that's a contra account to sales. And finally, there was a cash transaction. We received $1,000 from our receivable, so we're going to debit cash. Credit accounts receivable. So those are the transactions. Now what we want to do is we want to add, okay, the various T accounts. So my debit exceeded my credit by 1,069. My accounts payable, I have a balance of 1,800 because remember this was paying off that original purchase and then I bought an equipment, didn't I? For 1,800, that's still outstanding. Receivable is 750. Common shares did not change. Inventory is 2371. Now, if I was to go and physically count my inventory, it should be 2371. It should be worth 2371. And you'll see some other exercises in the videos where perhaps if they use perpetual inventory, if this ending balance does not equal what's in the warehouse, it means that perhaps there may have been inventory that may have either damage that wasn't recorded or wasn't counted properly or could have been stolen. So we need to be able to deal with that. But technically, that should be the ending balance in our inventory. Retained earnings. This is always the beginning retained earnings, right? So notice it's the same because we haven't updated it yet for all the current year's transaction, the sales transaction. Revenue, we only had one sale, so 1,800. Supplies, 590. Now it looks like we did not consume any supplies, but technically you would have used some of that supplies in April, but in this question it wasn't. So we're going to leave it as 590. Equipment's 1,800. What's missing here is we didn't amortize, right? We didn't, but remember this is April 27th, so technically by the end of April 30th we didn't use any of the equipment. That's why there's no amortization or depreciation. Sales allowance is 50 and cost of goods sold is 1170. Now, we're ready to create a trial balance. So what we're doing with a trial balance is we're going to post these ending balances into a thing called trial balance, and we want to make sure that our trial balance balances. So cash was 1069, and all I'm doing is transposing. And this, by the way, is a great way for us to know whether we were able to do two things. Whether we were able to, each transaction had a corresponding debit and credit, because that's the whole part behind trial balance, is making sure that it's a double entry. Accounting is all about a double entry system. And it also allows us to test to see whether we were able to post the journals to the T accounts properly. Now, having this balance does not necessarily mean we did a great job at analyzing the transaction and used the right account and amount. It just meant that we had a balanced entry and we were able to post those entries properly onto the T accounts. That's all it means when they say it's a balanced trial balance. Okay, so equipment was 1,800. Accounts payable is a credit, 1,800. Common shares is 3,000. Retained earnings is 1,200. And then we've got revenue, 1,800. Sales returns is 50 and 1,170. So if I add all my debits, okay, it should equal my credits. If they don't equal, it just means that A, I may have added incorrectly, or B, I may have reversed instead of debiting, because if I debited on my journal entry, I may have posted as a credit. So there could be multiple errors going on, but this is just a test to see that the double entry system works. Then the question asks us to do an income statement, and the income statement is just the statement of earnings, or income statement is just how did we do? What were our sales? What were our related costs? In this case, we sold 1,800, less we had a sales returns and allowance. That's a contra account to net sales. And then cost of goods sold is 1,170, giving us an income or profit of 580. So a couple of things to note. On the income statement, you'll see that there are three headings, three parts to the heading. First part is the name of the company. Now, in this case, it was capitalized here, but it doesn't necessarily mean it needs to be capitalized. Then the second is the name of the statement. And of course, there are 4 different statements that you saw in previous videos. This happens to be statement of earnings. It could be statement of income, or it could be an income statement. So there are a couple of terminologies that are acceptable. And in this case, because an income statement is a period of time statement, it goes from April 1st to April 30th, you need to say for the month ended April 30th, 2009. If you just put the word April 30th, 2009 there, it means it's a point in time statement. It's telling the reader it's the statement of point in time on that day. But you know that transaction, this should be reflective of the earnings for the period April 1st to April 30th. That's why it says for the month ended. And we are showing revenues and expenses to show what our gross profit is. And of course, this question could be a bit longer because it would also have other expenses as well. Thank you.